This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks. I'm John Budden, and welcome to Money Talk. Here's the lineup for today's show. We start with Dave Sally of the Ottawa Business Journal. Then we go to our affiliate BNN and Jameson Burko, and he's going to take a look at Trump's plan for phenomenal tax news and the stakes that it raises for the Trudeau visit to Washington next week. After the break, we go to my weekly chat with Matt Henricks of Sprott Asset Management, and then to Jason Mayer, who is a senior portfolio manager at Sprott Asset Management, and you won't want to miss that interview. After the news, to Eric Arnold, and he is the CEO and co-founder of Planswell. After the final break, we go to Jim McGovern, who is Managing Director and CEO at Arrow Capital Management, and he takes a look at the court decision on Donald Trump's travel ban. And then we conclude today's show with Jameson Burko, who looks at what's at stake for the first Trump-Trudeau meeting. But first, let's go to Dave Sally at the Ottawa Business Journal. It's great to be joined by Dave Sally of the Ottawa Business Journal today. How are you, Dave?
Pretty good, John. How are you?
Keeping warm and skiing and getting through winter.
Yeah, well, it's a good way to do it.
Dave, there was plenty of good news in Ottawa's jobs and housing markets this past week, while one of the city's largest tech employers launched a campaign to woo clients away from a competitor that has filed for bankruptcy protection in the United States.
That's right, John. Well, let's start with the latest jobs figures in Ottawa-Gatineau, which are on the rise thanks to a spate of government hiring. Statistics Canada said Friday the unemployment rate in the National Capital Region in January was at its lowest level since September of 2011. Employers in Ottawa and Gatineau added 2,600 workers to their payrolls in January, the agency said. That helped the region set a new record employment high of 725,100 workers. Combined with a modest decline in the labor force, this pushed the region's overall unemployment rate down to 5.7%. The impact of the surging labor market is already being felt across the wider economy. For example, the Canada Mortgage and Housing Corporation recently credited rising employment levels for pushing up the number of new housing starts in Ottawa. According to StatsCan's 3-month moving averages, much of the jobs growth is coming from the federal government. The feds added 2,600 jobs in the region last month, and since July, the federal government has expanded its local workforce by a whopping 16%, which amounts to 20,200 new jobs. The total number of federal civil servants in Ottawa-Gatineau has now hit 147,700, its highest level since March of 2010. The closely watched technology sector, meanwhile, lost jobs for the 4th straight month as employers shed 1,100 workers. The tech sector employed 40,400 individuals in January. That number is still higher than the levels recorded throughout much of 2015 and the first half of 2016. Nationally, StatsCan said Canada's labor market added 48,300 jobs last month, thanks to surges in part-time and private sector work.
And Dave, you mentioned housing starts are also on the rise in the National Capital Region.
That's right, John. The Canada Mortgage and Housing Corporation said Wednesday developers broke ground on 561 new homes in Ottawa last month. That's a 63% jump over January 2016 and the highest overall number in 3 months. CMHC analyst Anne-Marie Shaker said the increase was driven largely by new condos. She said condo builders may be encouraged by rising employment figures, but she added condo developers should still show caution due to a glut of unsold condos and the city's high level of apartment inventories. In addition to reporting actual housing starts, CMHC also calculates a seasonally adjusted 6-month rolling annualized average to show trends in new home construction. By this measurement, housing starts in Ottawa were trending at 6,565 units in January, up from 5,991 units in December. Last year, housing starts in Ottawa rose 6.5% to 5,298 new homes, but that was still below levels recorded over most of the past decade.
Finally, Dave, a local tech powerhouse is hoping to gain some new customers who might be wary about a competitor's financial health.
That's right, John. Ottawa telecom giant Mitel recently began targeting clients of U.S.-based competitor Avaya. This after Avaya filed for Chapter 11 bankruptcy protection south of the border last month. The company said in a news release it would undergo a restructuring process to cut its current debt load. And while Avaya does have a Canada presence down the road from Mitel, the company said foreign operations are not included in the filing and will continue normal operations. But that didn't stop Mitel from doing some subtle campaigning to perhaps lure away some Avaya customers. Mitel posted screen grabs on its website featuring various headlines announcing Avaya's filings, along with this message. If you're an Avaya customer or were considering Avaya, Mitel is ready to help. Now, Mitel's sales pitch positions it as a reliable vendor, quote, no matter what the future holds, unquote, and highlights its cloud-based communication subscribers. Mitel's partners are also joining in the campaign, with companies such as New Zealand communication firm Cogent running special promotions to help customers switch from Avaya to Mitel. Avaya came to Ottawa in 2009 through its $915 million U.S. purchase of Nortel's Enterprise Solutions business. It received $170 million in provincial funding the following year and moved into a 100,000 square foot office on Leggett Drive in 2012 before laying off a sizable portion of its local staff in 2013.
And Dave, what's coming up on OBGA's radar?
Well, John, as I'm sure you know all too well, tax season is just around the corner, and it can be particularly, taxing time for small businesses. Thankfully, the Ottawa Public Library is here to help with a seminar on everything SMEs need to know about preparing their tax returns. The seminar takes place on Wednesday at 7 p.m. at the main branch of the Ottawa Public Library at 120 Metcalfe Street. For more information, go to biblioottawalibrary.ca.
Thank you for an excellent update, and we'll talk again next Sunday at 2 p.m. Have a good week.
You too, John. Thanks.
Now to Jameson Burko and Alan Small with our affiliate BNN.
For more on today's top-line story, we're joined by Jameson Burko and, of course, my guest co-host for the full program, Alan Small, a senior wealth advisor at Alan Small Financial Group, Hollis Wealth. Jameson, how concerned should Canadians be, those of us who paid attention to this country's economy, about lower tax rates, corporate tax rates in the U.S., undercutting an advantage that we've had for some time in this country?
I guess it depends on how much Canadians care about the overall strength of our economy, Paul, because it's be very, very difficult to have a very strong economy without that tax advantage. Those are sort of, if you're going to have two big questions going into this meeting with our Prime Minister and their President about trying to get some more detail on just how phenomenal this tax reform package is going to be. Is it going to be something relatively straightforward and simple, just taking that headline overall tax rate, 35% at the federal level in the United States, and bringing that down to where, say, House Republicans want it to be at 20%, which would still give Canada some advantage with our federal tax rate at 15%? Or would they be willing to capitulate to the President of the United States and his desire to see it fall to 15%? Though remember, every time they lower it, every single percentage point translates to billions of dollars of revenue that the federal government is forfeiting in the United States. So there's also a complicating factor of exactly how they would make that money back. One of the ways, and this is where we're going to see just how significant this announcement is going to be, would be to implement that border adjustment tax regime that the House Republicans have been pushing for some time. So that would be a 20% tax on anything the United States imports into the country. There's various discussions, of course, about certain exemptions. Certainly the Canadian oil and gas industry would be chomping at the bit to be first in line for that. But that is the real risk, I think, to the Canadian economy, at least the immediate risk. The trickle-down damage that could be caused by losing our competitive advantage, companies moving back to the United States that have come to Canada, that's certainly a risk, and it could happen, but it's not something that's going to happen overnight, whereas a border adjustment tax, just one analyst example, National Bank Financial last month putting out this analysis saying a 10% border adjustment tax, which, by the way, is only half of what the House Republicans have suggested. But even at that lower level, Canadian exports to the United States would fall by 10%. That is a horrendous thing to happen if it were to happen.
Alan Small, same question to you. We've had an advantage on corporate taxes for a while in this country. The U.S. Political leaders haven't been able to get together and agree on tax cuts. It's a system in the U.S. riddled with loopholes. If Donald Trump sorts that out, if the Republicans sorts that out, is that a threat to Canadian competitiveness?
I think it is. However, you take the other side, perhaps. If they were to lower corporate taxes in the U.S., would corporations then have the capacity or the money to go out and buy more of our goods? I think there's the argument there that you lower their taxes, you lower their healthcare costs, you lower regulation or deregulate. A lot of these corporations feel the advantages of that. Will they then buy more from us? Now, I guess, would that offset perhaps a rise in border taxes or perhaps some of that competitiveness? Will that offset some of that? Because as we know, we export, about 70% of what we take out of the ground and build up here to the U.S. So is there a bit of an offset there? I think that's maybe a point to take a look at as well.
That's a very important point to have, especially with the really a lot of seemingly consensus forming on Bay Street around all the negative implications, but leaving the currency adjustment issues aside, because that's, for the economists to debate. There is a benefit, potentially anyway, I wonder what you think about this, Alan, of making American goods less expensive for Canadians, since the border adjustment tax would make all exports tax-free. So from that argument, one could see a scenario where Canadians actually get a little bit of a benefit from that system, though it's difficult to imagine whether or not that'd be enough to what would you think about the offset impacts of that?
I agree. I don't know if it would totally offset anything like that. But again, I think that in a situation like this, there would be some positives that come out of it. It's not just all negative. I think there can be some positives of this. And I guess taking from the president's standpoint, obviously his country's been getting the short end of the stick for a number of years. He's now trying to, as he puts it, level the playing field. And can you blame him? Can you blame them from wanting to level that tax rate? So I kind of see their point. At the same time, yes, obviously it's going to affect us up here in Canada. And Mr. Trudeau going to Washington over the next little while. We'll see what comes out of those meetings.
We'll go to a break, and when we come back, Matt Hendricks and Jason Mayer of Sprott Asset Management. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, it's great to be joined by Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management. How are you doing, Matt?
A little chilly this weekend, John, but no worse for the wear.
We've had markets that were euphoric again this week, and they seem to like the idea of less regulations, lower taxes, and Donald Trump seems to be trying to revive the airline industry by executive order. I have a really good interview with Jason Mayer, who is a senior portfolio manager at Sprott Asset Management, and he oversees the flow-through partnerships, and he manages the resource fund. I'd like you to give us a bit of background on Jason and also speak to the fact that the flow-through fund is almost sold out, and if people wanted at the last moment to talk to you, they should do it, but fast.
Yeah, for sure, John. No, Jason Mayer came over to Sprott in 2013 to basically take over our flow-through franchise. Now, when you're in that space, you obviously need to be an expert in the resource sector, obviously energy and mining. Since Jason has come over, he has absolutely dominated the flow-through space. His limited partnerships have outperformed his peer group every year and have provided a win for our flow-through investors since 2013. The resource class fund that he manages is a one-stop fund for energy and materials. So, of course, we have Eric Nuttall, who runs a pure energy fund, and we have Paul Wong that runs a pure gold and silver fund. Jason runs this resource collaboration. It's got a mix of energy, which has got oil and gas. It's got a mix of materials, which could be silver, gold, diamonds, and base metals. And he's number one in Canada, by the way, in the resource class fund for the last 1 to 3 years. His 1 year number is 88.3%. He's just done a fantastic job, and I really look forward to our listeners hearing his interview on flow-through and the resource space. And yes, the flow-through fund is almost sold out, so if there's anyone out there that wants to hear more or potentially pick some up, you better get on it. Call your advisor first thing Monday morning, because I doubt if there'll be anything left by Tuesday or Wednesday.
Matt, for listeners and advisors who would like to speak to you as soon as possible, how do they get in touch with you?
Sure, John. I'm available toll-free at 866-299-9906. And, of course, I'm reachable through Sprott.com.
Now to Jason Mayer, Senior Portfolio Manager at Sprott Asset Management. It is a great pleasure to welcome Jason Mayer to Money Talk. How are you, Jason?
I'm good, thanks, Sean. How are you?
Great, thank you very much. And you are a Senior Portfolio Manager at Sprott Asset Management. And I'd like to start off by asking you about your background and role at Sprott Asset Management.
Well, I've been involved in the investment management business since 2001 with a focus on resources. And at Sprott Asset Management, I am one of the portfolio managers on our gold fund, and I'm also the lead manager on our resource fund and the flow-through funds.
And I see you've got an MBA from the Schulich School of Business, and you are a chartered financial analyst.
That is correct.
Well, let's start with a definition. What are flow-through shares?
So flow-through shares are regular, ordinary common shares that are issued by Canadian resource companies. And the only caveat is that the purchasers of those shares are able to deduct the cost of those shares from their taxable income. So essentially the purchase is 100% tax deductible.
And we are in tax season now, and so this is a focus of attention for most people. What is a flow-through limited partnership?
So the limited partnership vehicle essentially enables the investing public to participate in the issuance of flow-through shares. So essentially what the partnership does is it goes and collects money from the investing public, and it takes those proceeds and goes and purchases shares that are issued on a flow-through basis by Canadian resource companies. So that at the end of the day, what the investor is getting is a pro rata interest in a diversified portfolio of resource companies, and their investment is 100% tax deductible. And that's pretty noteworthy because essentially what that means is that for those taxed at the highest marginal rate in the province of Ontario, their break-even point is approximately 60% of what they have initially invested.
And what does this year's Sprott 2017 flow-through limited partnership look like?
Well, currently we're in the process of raising the proceeds, and it is going extremely well. We're almost sold out, and right now, given the current landscape in the resource space, I am seeing a lot of opportunities from quality companies that are interested in issuing shares on a flow-through basis. So at this stage of the game, I am very encouraged.
And what is the track record of 2015 flow-through partnerships and 2016? And I believe you had a second flow-through fund in 2016 as well.
That's correct. So the 2015 fund, which was launched in early 15, that terminated last week, and the after-tax rate of return for an Ontario investor taxed at the highest marginal rate was north of 50%. And the 2016 limited partnership, which was issued in May of 2016, also terminated last week. And those investors, too, enjoyed an after-tax rate of return of north of 50%. And it's important to note that the hold period for that particular partnership was only 9 months. The 2016 2 partnership, which we issued in the fall, is still ongoing, and the current net asset value is north of $23 per unit. So that, too, is performing exceptionally well to date.
Investors can always get a hold of Matt Hendricks, who is Senior Vice President National Sales for Sprott Asset Management here in Ottawa. But they better be nippy because I understand that you're virtually sold out. Is that correct?
That is correct. Yeah, we're approaching the maximum of the offering, which is $50 million.
And in addition, Jason, you are the manager of the Sprott Resource class. Could you give us a bit of an idea of what that vehicle is and what the performance has been?
Sure. So the Sprott Resource class is able to invest across all resource mandates. And typically how we like to run this fund is we don't like to bet on any particular commodity, so we try to mitigate the commodity concentration. And it really is a fund that is focused on generating alpha, i.e. picking really good stocks that are going to outperform your benchmark. And the proof is in the pudding. So for the one-year return number for the year ended December 31st, 2016, the Sprott Resource class returned 88.4%. And this compared incredibly favorably to the benchmark, which returned only 43%. So we outperformed the benchmark last year by 45.5%. And in addition, if you compare the fund's performance to the peer group, like I said, the fund last year returned 88.4%, and the peer group returned 39.8%. So the performance has been exceptional, and in addition to that, it had a comparable risk rating when compared to the benchmark. So, message being we are not taking on excessive risk to generate those types of returns.
Now, that's a great investment story. Thanks so much for joining us today, and we'll look forward to talking again soon, and all the best.
Thank you, John.
Now, wasn't that a great interview, Matt?
It was, John. Again, Jason really knows his stuff. Has added nothing but wins for us in our flow-through franchise, as well as our clients holding the resource class fund. And I highly recommend that listeners get a sleeve of resource to add a bit of alpha to your portfolio.
Well, he does really good investment work. And before we go, if you could give us your coordinates again for listeners and advisors.
Absolutely. Toll-free, 866-299-9906. And always remember to visit Sprott.com.
Matt, thanks. Have a great week, and we will talk again next Sunday at 2 p.m.
You bet, John. Have a great weekend.
We'll go to the news, and when we come back, Eric Arnold, who is the co-founder and CEO of Planswell. Stay with us, folks. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
It's a pleasure to welcome Eric Arnold, co-founder and CEO of Planswell, to Money Talk. How are you, Eric?
I'm great. Thank you so much.
I'm very excited about this because we finally have a disruptive technology arriving on the doorstep of the financial services business, which is really a bastion of traditional methodologies. To get started, Eric, tell us about your background and expertise.
So my background is actually pretty varied. I've started a number of different companies in different industries, generally focusing on digital marketing before I ended up actually as an investment advisor for one of the big bank brokerages, which is kind of a neat combination of a few different backgrounds coming together to make Planswell.
Now, can you describe Planswell?
Yeah, so when I was at this big bank brokerage, I was figuring out ways to engage people with financial planning, and I was doing such a good job at it. I eventually actually started my own marketing company for advisors, and I was attracting people to request financial plans. One of the problems I was coming across is that about a third of the people coming in were of net worth. The advisors wouldn't be able to service them. The banks actually prevent advisors from servicing people with less than certain benchmarks, a couple $100,000. So I kind of realized at that point, this is back in 2013, that we needed to not only attract people to financial planning, but then also to create the financial plan and then also to implement the plan for them so that we can service all Canadians instead of just the wealthiest of the wealthy.
Well, if I want to take advantage of Planswell's offering, how do I do it?
Yeah, so people just go to our website at Planswell.ca, and within 4 or 5 minutes, typically, you can create an entire financial plan. And when I say financial plan, I'm not just talking about a risk tolerance for investment, which is what a lot of companies will call their plan. We're actually creating a very comprehensive plan. It talks about everything you need to do on a monthly basis to make sure that you achieve your goals, whether it's putting your kids through school or arriving at retirement and not having to reduce your lifestyle after that. So it's quite a comprehensive plan. It even talks about what's going on with your debts and your mortgages and puts it all in one place to understand what you need to be doing. So you can create that on the website, and it's completely free. You can take the plan and do whatever you want with it. But we can also implement the plan for you, which enables us to better manage it and track it on an ongoing basis, update it in real time. And every 6 months or so, we kind of ask you to go through some of the questions again to make sure that your plan's always up to date.
Well, tell us about your team.
Yeah, so the team is amazing. We have about almost 30 people working in our office in Toronto. It's not a lot of people from the financial industry, actually. We generally started with a team of developers and a bunch of university textbooks that we bought online about financial planning and said, look, we're going to start from scratch and build the world's greatest financial planning software. And then along the way, actually attracted a number of different people, advisors, certified financial planners, people that really bought into the idea of creating financial plans for everyone. And it's a pretty passionate team we have.
Now, if I upload all of my financial information to you, what assurance do I have that my information is absolutely private and secure?
Absolutely, yeah. So we follow all of the same best practices as all of the different banks. The technology team can do an amazing job of articulating the way that they keep things safe in the background, terms like HEPA-level compliance on the survey forms. The actual investments that people are making are being held by the custodian, not by us. So the custodian's sole purpose is to make sure that your money is safe. That's what all of the portfolio managers use across Canada. So I can assure you that it's definitely safe.
families have to contend with all the minefields that are out there, not to mention political disruption and risk, but they're concerned about debt. They're concerned about interest rates, real estate, saving for retirement, equity and fixed income investing, insurance, education, medical coverage. Do you have the resources in-house to help your clients with all of these factors, or do you source experts that are independent outside? And what sort of deal is there between you and suppliers, if that's the case?
Yeah, so one of the really kind of amazing things about what we've built that sets it apart is how intelligent the actual software is. So you provide the information that you can answer off the top of your head. They're easy questions. You go through about 40 of them, 4 or 5 minutes. And what it's going to do is it's going to take all the information that you shared. It's actually going to be creating hundreds of thousands of plans in the background and then creating new questions to keep you on track to making a plan that you've agreed to every number. There's no sticker shock. And that plan is going to be absolutely what's mathematically in your best interest. So you don't have to worry about a whole bunch of different choices of this or that. It's going to tell you exactly what kind of investments you should be making, how to manage the risk, how to allocate your dollars across the different registered accounts that you have to optimize for after-tax income at the time that you spend the money. It's going to talk exactly about what kind of insurance policies you would need to protect your plan and how to get them at the very lowest cost possible. And then it's going to talk to you about your debts, and it's going to say, hey, if you're actually carrying credit card debt, for example, that's probably what you want to be focusing on paying off instead of actually putting money towards investments right now. It's going to tell you what's in your best interest, and it's going to be able to make recommendations on what kind of mortgages you should be having, what kind of rates you need, where it really makes it easy for you to just say, okay, let's do it. And then within another 5 or 10 minutes, we can actually put the whole plan to work for you.
And how do you source and do your due diligence on people who you think are qualified to provide advice in these specific areas?
Right. So the team that's actually building the engine is a very experienced team with every kind of designation you can think of, making sure that the assumptions we use are the best possible numbers that we can be using. And we actually disclose that to all the clients that want to dig really deep and understand how we're making these calculations. You can read up about it completely. I think what you might be asking is, when we actually implement the plans, where are the investments coming from, where are the insurance policies coming from, where are the mortgages coming from? That's all handled essentially in-house. We work with Planswell Portfolios, which is considered kind of a sister company. It's registered with the OSC as a portfolio manager, and that's going to set up investment portfolios that the portfolio managers have created. They use exchange-traded funds, very low-cost investments. And then on the insurance side, we're actually working with insurance companies to build our own custom products. That'll be coming out a little bit later this year. And in the meantime, we've sourced the lowest cost policies that we can possibly set up for people. And then on the mortgage side, our mortgage agents are in-house as well. They're licensed mortgage agents, and what they're doing is they're setting up mortgages with the top lenders that can get the lowest possible interest rates. So some of the top kind of lenders that we're basically keeping the relationship in-house when people want to implement the plan with us, so that we can make sure that it's always the best interest of the client, how they're being implemented.
And what is the ongoing fee arrangement for the client?
So because of the way that this is set up and how easy it is to use and the scale of our business, we're able to get the costs down considerably lower than where you could implement this in other parts of the industry. So on the investment side, generally coming in at about 0.5% to manage the money, and it actually drops down to 0.4% once you reach $100,000 of investments. On the insurance side, it doesn't cost anything to use us for insurance. The insurance companies compensate us for setting up the policies, and the same way that the mortgages work. Typical with any kind of mortgage broker, the lender is going to compensate us more upfront, but it doesn't come out of the client's pocket. But what we do, because our people that are assisting us in setting these up in-house with us, they're all salaried employees. There's no kind of focus on getting a bigger commission or charging the client more. We're able to come out of the gate with the lowest prices in the market because we're more focused on servicing as many clients as possible as opposed to maximizing how much we earn off of each one.
So you participate in the supplier's fees, but the client does not pay any more for your advice. It's taken into account in that fee.
Correct. And we disclose it. Like when we do a mortgage for somebody, we tell the client how much of a commission we earned. And it's generally less than half of what a mortgage broker would be earning, which is how we're able to come out of the gate and actually buy down the rate that we're offering for the client. right off of the bat.
If somebody submits their information and decides that they don't want to continue on and do business with you, is there any charge?
No, you can walk away with the plan completely free. You can take that, implement it somewhere else. I can't find anywhere else that you would implement it for anywhere close to the cost that it would be to implement it with us, and you'd probably actually end up going to 3 different companies to put it into play. But yeah, it's a completely free plan.
And again, I just want to confirm and have the assurance that the information does not go on to anyone else.
No, so there'd be no incentive for us to have the information be at risk. We're definitely in a trust kind of environment with our clients. Extremely important for our success as a business. But the information is definitely secure. And
you want people to think it over, and they may come back at some later date, so that all makes sense. Yeah, absolutely. We actually have a good team of people standing by to talk to people on the phones. What typically will happen is someone will create a plan, and they'll take a look at it, and maybe they'll think about it like you're saying, and then they'll choose to hop on a phone call with us. Sometimes they have questions about implementing it. Sometimes they have information that they may not have shared in the actual plan building process that causes the plan to need to be adjusted. And that's something that we can do over the phone with them in real time to make sure that the plan is absolutely what's in their best interest before going ahead to implement it. So if one does one's plan, then after that, if you have questions, you can find an expert who will talk to you and explain the various opportunities and services and then go to the next step. Exactly, yeah. We can get on the phone and talk to people about it. If they need, if they have specific questions about their investments, we can transfer to a portfolio manager, from Planswell Portfolios. We can transfer it to a licensed insurance person or a licensed mortgage person to really get into the details with people. We have all of these people in-house standing by. Well, given that a good traditional financial plan costs thousands of dollars and will give you a very nice thick book that will have lots of charts, circles, and arrows and probably be out of date upon arrival, this looks like a very efficient and economical alternative. Not only efficient and economical, because it's free, it's also considerably better than the plans that you just described. You're right, the typical plan is 20 to 30 pages of graphs and charts. Our plan is 1 page, no graphs, no charts, and it actually includes insurance and debts in a way that talks something that no other financial plan is really including. So yeah, we're very proud of the plans that we're creating for people. Well, for listeners who want to avail themselves of this offer, could you explain the steps, that is, your website and what would be required and what they should prepare in the way of information before they set out to fill in all the information? Yeah, that's something that we've worked long and hard on making it as easy as possible. We kind of found that if people had to go dig through their closet and find some mortgage statement or something, it would drastically reduce the number of people who could create a plan for themselves. So all it takes is to go to Planswell.ca. Within seconds, you can be building your plan. The plan is about 40 questions. It changes depending on your situation. As I was saying, the questions get adapted. They create new questions. But it takes about 3 or 4 minutes to create a plan. Every single question can be answered off the top of your head without really thinking about it in advance. We can make certain assumptions around that to give you a plan that is very accurate and very thorough. So it's a really neat process of creating a plan. Typically, if you're familiar with it, you have to meet with a planner on several different occasions. So it's a very refreshing change for the industry. Well, this is a great story. And for listeners, I'd like to repeat the website. It's Planswell, Planswell.ca. And
correct.
Eric, thank you so much for joining us today. And we'll look forward to catching up with you again soon. And we wish you all the best in the evolution and introduction of this new technology.
Amazing. Yeah, thank you so much for having me.
After the break, we go to Jim McGovern, Managing Director and CEO of Arrow Capital Management. Stay with us, folks. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Interesting you brought up Donald Trump. I want to share some breaking news here in the BNN newsroom. Appeals court in the state hearing the case of the immigration fight over Donald Trump's immigration ban says it will keep U.S. doors open during this immigration fight, because every day they're saying we're not going to have an answer. Today it seems that pending a decision here that they will actually keep those borders open. It's an interesting one it sort of takes us back to the beginning of our discussion that the pro-Trump policies being good for the American economy. A lot of people argued, though, if you shut down those borders, you're going to stop the inflow of people that actually feed the economy, that can make America great again.
Yeah, well, there's no question. There's obviously a lot of rhetoric on both sides of the equation. There is one school of thought on some of these work visas and opportunities that are given to non-U.S. citizens need to also be dramatically overhauled. And I've sort of read through some of the work on that, and I would tend to agree with that. So in other words, some of these folks that are coming in are actually really being taken advantage of. On the flip side, when you have people like Tim Cook and a lot of the big tech executives that rely on a lot of that tremendous innovation to drive their business. They want to basically get the best and brightest minds from anywhere in the world. So I can kind of see both sides, but at the end of the day, clearly a more open door policy is better for business.
You think it's been overplayed on this side of the border, saying, well, if the Americans start closing their doors to the world, then we get all these top brains and all this top talent. They just suddenly just say, take a little bit of a right turn, shoot up to Canada, and suddenly we have a booming tech sector.
Absolutely, I think it's a little overdone. Not that we don't have an opportunity, and not that we shouldn't be doing this anyways. I mean, it's an open market, it's a competitive world. We should be trying to get these people in with or without a Trump policy issue. But I think at the end of the day, a lot of folks will also want to see what Trump has to say on trade and how that's going to work out. Because obviously, if things get a little tighter, a little dodgier, people will still probably want to prefer to go to the United States.
All right, we're going to take a short break. Just want to recap that news. The U.S. will remain open to refugees and visa holders while this travel ban is being debated by the appeals court. Perhaps it's going to make it all the way to the Supreme Court.
Now to Jameson Burko and what's at stake for the first Trump-Trudeau meeting.
Prime Minister Justin Trudeau is traveling to Washington, D.C. Monday for his first in-person conversation with the new President of the United States. Issues critical to Canada's economic health certainly expected to be on the agenda. What do we expect? For the answer, we turn to BNN's Jameson Burko.
Well, much like the tax plans that the President has in plan, Michael, phenomenal. That word, of course, was what Donald Trump used to describe what is coming down the pipe in terms of potential changes to the corporate tax code in the United States. The reason this is so relevant is because Canada has a pretty strong advantage when it comes to the corporate tax rate, less than half, at least on the federal comparison to that in the United States. So if that goes away, could cause some concern for our economy in terms of its attractiveness to other investments. Now, even if the President of the United States expects the tax changes to be phenomenal, Alan Small did remind us on the street this morning just how many questions about it remain unanswered.
And the other issue, I think, is the border taxes. Goods coming into the United States from our country. How are they going to pay for this cut in taxes is my biggest concern. Obviously, there are many things being floated around by Republicans. How's that going to affect our goods coming into their country?
Likely going to be a major question that our Prime Minister is going to ask their President, because there is a whole slew of data and analysis out there suggesting that it would not be at all positive, Michael, for our economy to see that border adjustment tax in place. In fact, National Bank Financial has some math out there suggesting even just half the level of taxation that congressional Republicans want to impose, so a 10% tax on Canadian imports into the United States, would drop our exports to the United States by as much. 10%. That's a calamitous economic outcome for us.
But there is one major Canadian industry that figures it would dodge that bullet if it ever was fired.
Right, the oil and gas sector, of course. That all coming from the CEO of Suncor, Steve Williams, just yesterday saying he's pretty sure that Rex Tillerson, the newly confirmed Secretary of State in the U.S., of course, the former CEO of ExxonMobil, might be able to help steer the oil sector clear of any of those taxes. That's going to be something likely you can expect our Prime Minister to address as well, particularly one project that is in the works through the bureaucratic machinations of the United States government. Michael, of course, the Keystone XL pipeline. The clock is ticking on the approval process there. Remember, it was a 60-day timeline that President Trump had set, subject to a renegotiation of terms, according to him. We'll see whether or not Justin Trudeau wants to be at that negotiating table as well.
All right, thank you.
My pleasure.
Jameson Burko. For more, you can learn about what to expect on his blog between Mr. Trudeau and the U.S. president by going to bnn.ca.
Well, that's it for Money Talk. Thanks so much for joining us today. Have a good week. We'll be back next Sunday at 2 p.m. I'm John Budden, and you are listening to 580 CFRA.